Hey guys, how's it going today? So today we're going to do a quick video on what is a future value and what is a present value. Now this is the fundamentals of finance. When you go to business school, this is one of the first things that you learn. Um, and I actually have my degree in finance, and this is something that I use all the time. You use this to value stocks. You use this to find out what's the better deal, financially, what's the better thing to do. We're going to look at it in a very basic sense right now. That's basically future value and present value. So basically, let's look at future value first. So we're looking for the future price. Say we have $100 now, right? Value now, which we call the present value because it's in the present, is $100. Let's say that the growth per year is 10%. Now this is basically what we get on indices. If you don't know what those are, please watch my other video. And I'll show you that after as well, that basically on average that's what you're going to get in the stock market per year for the whole stock market as a whole. Let's just arbitrarily use 10 years here, and we don't know what the future price is. Now a lot of people that have just a basic understanding of math could do this on paper, or they could do it in Excel here, and it's pretty easy. It gets a little more difficult when you're talking at 50 years or longer, right? So what most people would do is they would start with $100. And please don't worry if you don't understand Excel. I'm going to be explaining what I'm doing. I just want you to understand the concept. So they're starting with $100 here, right? So what I can do is I'm using a basic function here. Click $100, and I can times it by 1.1, which would be increasing it by 10%. As you can see here, $100, 10% of that is $10, turns 110. So that's the first year, right? A beautiful thing that you can do in Excel is you can just drag. You see this? You're just dragging across, and it just drags across, as you can see. It'll highlight it here, the function. So now we're at 110, and we're doing 10% of that, and what is that? That's 121, because it compounds. Just like if this money was in the bank at 10%, it would compound, or like if it was in the stock market, it would compound, or some sort of investment like a house or something like that. Say the stock market goes up 10% today. For the sake of argument, the whole market won't go up by 10%, but for the sake of argument, and then it goes up 2% the next day after that. Well, now it's compounded on top of the 10% it's already went up, right? So if we drag these across here, I'm just going to drag a couple here. It's going to be much further. I think that's 10 years. Let's see here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So in 10 years, it'll be worth $259.37. So there's a quicker way to do this. I just wanted to show you this, guys, so you can understand what it is. We just calculated a future value. That's the future value. But there's a function that you can use here. So the function is future value. Don't worry if you don't understand. I'll explain here. First, it wants the rate. Well, that's what we're talking about, 10% a year. So I can just click on that, right? Then I put a comma. So the number of years, we already said that, right? 10 years. So we can just click on that. Payment, this is what's so powerful about this. You could add, say per year you wanted to invest another $100 on this, whatever you wanted to invest, it would calculate that too. That's a lot more difficult to do by hand. But for this example, we're just keeping it simple. There's going to be no payment. It's just $100 we're putting in, let's say the bank to make it simple here. And it's getting 10% a year. So nothing there, we'll skip by that. Now it says PV, it wants the present value. Well, that's the value now, like I said, the $100, so we can click on that, right? Type, don't worry about type, that's whether it compounds at the beginning or the end. If you don't put anything in there, I believe it goes to the end, and that's what we want in this example. Click enter, and what do we get? $259.37, the exact same thing, right? So this is all related to the topic of, a dollar today or a dollar tomorrow. That's the first question that was ever asked to me in business school. Would you prefer this dollar now or a dollar tomorrow? And obviously, the answer is I prefer it now because tomorrow it'll be worth more if I could put it in the bank. Well, generally speaking, it's going to be worth basically nothing more tomorrow with today's interest rates and such, but the general concept behind it. And that's the kind of thinking that you guys should be thinking about too if you're interested in finance. Everything you do in life, you can do these calculations no matter how limited or advanced your knowledge is. And if you guys want me to make more videos on this, explaining a little more complex ones with cash flows or things of that nature, I can definitely do that. So now let's just quickly look down below here at present value. See, we had future value here. Let's do a present value. So you can probably guess what's going to happen here. But the future price is $259.37. As you can see, you can probably guess what we're going to do here. But I'm just demonstrating a point that it works, that it goes both ways. So we could use the present value function. That's PV, right? So the present value function, we're going to do the rate. Don't mind that there, guys. I'm just going to have to quickly plug in. Sorry about that, guys. Okay, so the rate, like we said, is 10%, right? Okay, now the number of years, we did this above, 10 years. Payment, like I said, we're not worried about that. And now it's asking not for the PV as above, it's asking for the FV, which is the future value, which we have here, right? And again, we're not going to worry about the type. It's going to be the end. And there it is, $100. So I just demonstrated here, and I'm going to I'll leave that for you guys so you can see it there. But I just demonstrated how this works and why this is so powerful. So to kind of extend off that, hopefully that's not confusing to you guys. This question here that I'm going to pose to you is actually a present value question, because this is why it's so powerful. It's nice to be able to project out the future, but it's even nicer to, when you're given choices, to know what to do. And this just is a demonstration of how powerful a present value is. This one's probably pretty easy. You could probably figure out one way or the other, but I'll show you here. So you have the choice. So the number of years is 10 years. So in 10 years, I'll give you $1 million. Or in 15 years, I'll give you $800,000. So, I mean, depending on the numbers and whatnot, it cannot be so obvious. But this is the part that comes into play too. 2% your bank gives you. So you got to keep in mind that when you get this, well, this is actually, I have these backwards. That would never make sense. Sorry, let's put 15 years and 10. Sorry to confuse you guys. So keep in mind, in 10 years, you'll have $800,000, whereas 10 years here, you will have nothing. So in 10 years, this $800,000 here can make 2% for the additional difference in years, right? So that's what makes this question confusing to some people, and there's other, obviously you can build upon it and it can get much more complex. But just to show you what we did before, so you do a present value. You want to take this to the present, this data here, this $1 million at that percentage, at that number of years, and see what it's worth. Whichever one's worth more, that's one that's going to be a better deal. So present value. Rate, well, we said the bank pays 2%. The number of years, 15 years. The payment, well, like I said, we're not worrying about that right now. And the future value is $1 million. And the type, like I said, doesn't matter about that right now. So in the present value, don't worry about these negatives either, guys. This weird thing with Excel is $743,000. So that's what would be worth today, given that time frame and that percentage. So let's do this one. The present value is rate 2%, number of years 10 years, payment nothing, rate, future value 800, and again, don't worry about this end thing. So it was kind of close actually, right? But this is still a better deal. Even though in 10 years you get 800,000, it's better to wait that 15 years at to get the 1 million. But then you can do things like you could change this. Well, what if the percentage was 9%? Now, do you see what happened there? I'll go back. The top one was a better deal, which was $1 million, right? But at 9%, this one's a better deal. So see how powerful that present value is? Because you're getting 9% on that $800,000 for the remainder of years, this is a better deal. So you would say, no, I'll take the $800,000 in 10 years if you believe that you get 9%. If you had an investment that you get 9%, or you're going to put it in the market. The market on average, if you buy an ETF that tracks the market, will do 9% a year on average, right? So that's the power of it, right? So I wanted to just go over one last little thing here, and this is the very last thing, just to show you kind of a real world with the stock market. I'm going over this right now because I'm going to be making a video in the future about housing versus renting. I might have mentioned this before. The general advice that has always been given in my part of the world is buying a house as young as possible is the absolute best thing that you can do. But by getting knowledge and getting my degree in finance, I've learned that's definitely not always the case. And actually, in many cases, it depends on where you are. It depends on a lot of different things. That's actually very bad advice, and I get a lot of hate for that. But I asked people, I say, have you ran the numbers? And none of them have actually run the numbers, right? So, I mean, don't take what I'm saying right now as to be the absolute truth. I'll do a video on this later, hopefully when there's more people watching my channel, because I think it's a very important concept. But this is kind of part of it that shows how the stock markets grow and some of the proof behind it. So basically what I have here is in the price in 1978. We're doing approximate here. I think this was in September, like was about about $89. I did the price in the same month, 2017. It was about $22.74. So that's 39 years, right? And then I put the growth as 9% here, but more likely the growth is about 10% per year. That's usually what's quoted. Some people might dispute that, but if you actually do the hard data, it is true. And here's some hard data right here on a lot of different things. You don't really have to worry about too much, but we're talking about the S&P 500 because it's easy. So as you can see, here's a good example if you knew about the Great Depression. I mean, it was rampant. Yeah, this year it went up 43%. 1929 it was down 8, then 25, and 43. There was your Great Depression, right? So it was very volatile. But these have been calculated, like I said, on average. You can't expect to predict what the stock market does, but on average, over long periods of time, it will produce around 10% a year. So if you have a long mindset, you're going to do very well. And in my opinion, better than many other, if not all other investments, given the risk. So let's look at these here. I'd prefer to look at a geometric average. Let's not get into this discussion right now, but basically what this takes into account is the years that you have big losses. When you average them out, they almost kind of disappear. But here, if you say you lose 100%, but you really don't have that money anymore to invest. So this number is going to be lower. So we'll go on the low end here. So we have 1928. This is closer to the time period that I did, right? 1967 to 2016. It's saying about 10%, like I said, right? So let's do it then. First, I'll prove to you guys that those numbers are actually true. I said 1978, right? So we're looking on Google Finance here. 1978, August, believe it was January. I'll actually correct myself that I was looking at here. If I can get back that far. Well, let's just look at February. It was $89.62. What do I got here? $89. Pretty close, right? So that was in February 1978. Let's go February. I'm looking up here, by the way, guys, if you're not too sure, that's where I'm looking. Now I'm going to be looking at 2017. You can see it changing on the top right there. 2017, February, 23.51. Okay, let's put 23.51. It's closer. This is just averaged or approximate too, right? So if you were sitting back in 1978 and you had this data and you said, well, on average, the stock market, given the data that we have, I mean, we have way more data now. We have data from back to 1928. That's what makes it so reliable. But say you had as reliable data. You say, well, if I invest my money rather than buying a house or doing some other type of investment at 10% a year, what is it going to be in 39 years? Well, this is what I showed you over here, guys. It's just a present value calculation. So you go equals present value. The rate, like I said, 10%. The number of years, 39 years. Payment, we're not going to add anything to it. We're just going to put that, we're going to buy one share of the whole market as a whole for the sake of argument at $89 and leave it. So there's no payment. Sorry, guys. I did present value. We need to do future value. If I confuse you there, I really apologize. Sometimes I'm just doing these videos on a whim and I make mistakes. We're looking for the future value, right? I said it's 1978. We're looking for the future value. Okay, so again, rate 10%. Number of years, 39 years. Let's do it right this time. Payment, nothing. Present value is $89. This is what we're looking at here, right? And again, don't worry about compounding at the end or the beginning. So you see, at that rate, we're looking at, what's the difference here? I'm going to just do something here to get this into a positive number. we're looking at a difference of 1,300. So some people are a little bit confused by that, right? I did put 10%. The averages here are for different time periods, so it's going to be different. Keep that into account. And also depending on how it's calculated. But for different periods, say like here, this period is 9.53%, so we can put roughly 9.5, and it's closer yet. Did that go in there? Let's put 9%. Then we're getting closer yet. And another thing that I don't want to get too complicated here, but another thing that is not calculated in these, I believe, is that this is looking at stock prices. This is not looking at dividends. So what that means is this is just the price increase, right? But if you held the whole market, the S&P 500, like go back to my other video where I explain what the S&P 500 is, many of those companies have dividends. And if you take those dividends and reinvest it back in the market, you're going to easily get the 10%, or that's basically, I think, where their number comes from, right? But again, like I said, these aren't the exact dates, but this shows you how close it is there. And that's basically proving to you that, hey, that's how the numbers work, and that's how present value works. We could do some exact dates if you wanted on here and show you the future value increase, but it's kind of irrelevant. It's just to kind of get the point across, right? Take the power of the future value and the present value. And I think I've stressed that quite a bit here today. So if you guys have any questions, I just wanted to make this a pretty quick video and end up being a little bit long. Any questions, leave them down below. Don't forget to comment, like, and subscribe. Hit that notification button too so you know when I release videos. And if you'd like to see me do kind of more videos like this in the future, or more complicated ones in regards to making it a little bit more realistic to real life situations, definitely comment that down below too. Anyway, have a great day, guys, and I'll see you in the next one.